Credit limits are an important component of revolving credit accounts because they define the maximum amount a borrower can access at any given time. The topic of this lesson, how credit limits influence your credit profile, focuses on understanding how these limits contribute to the way lenders interpret credit reports. When a lender issues a credit card or line of credit, the institution assigns a credit limit that establishes the borrowing capacity associated with that account. This limit represents the maximum amount the borrower is permitted to use, unless the lender later adjusts the limit based on changes in financial circumstances or account performance. Credit limits play a significant role in the credit profile because they interact directly with account balances to determine credit utilization. Utilization describes the percentage of available credit that is currently being used. For example, if a credit card has a limit of $10,000 and the reported balance is $2,000, the utilization rate would be 20%. This percentage helps lenders evaluate how heavily a borrower relies on available credit. Lower utilization often signals that a borrower maintains flexibility within the credit limit and is not approaching the maximum borrowing capacity. Higher utilization may indicate that a large portion of available credit is already in use, which can sometimes suggest financial pressure. Because of this relationship, lenders often evaluate credit limits and balances together, rather than examining either number independently. A borrower with higher limits and relatively moderate balances may appear less constrained because the available credit cushion remains substantial. In contrast, a borrower with smaller limits and balances close to those limits may appear more dependent on the available credit. Credit limits also contribute to the overall borrowing capacity visible within the credit profile. When multiple revolving accounts exist, the combined limits create a larger pool of available credit that can influence how lenders interpret utilization patterns across the entire report. For instance, a borrower may have several credit cards, each with its own limit. When those limits are added together, they represent the total revolving credit available within the profile. If balances remain moderate relative to those combined limits, the overall utilization may appear balanced even if one individual card shows a somewhat higher balance. This broader perspective explains why lenders frequently examine utilization, both at the individual account level and across the entire profile. Another aspect of credit limits involves how they change over time. Some lenders periodically increase limits for borrowers who demonstrate consistent payment behavior and responsible credit management. These increases may expand the available credit cushion associated with the account. In other situations, lenders may reduce limits if they perceive increased risk associated with the account. Such adjustments can influence how utilization appears within the report because the percentage used will change whenever the credit limit changes. Understanding this relationship helps explain why credit profiles may evolve even when balances remain similar. Credit limits also interact with the age of accounts and payment history to create broader patterns within the credit report. An older revolving account with a stable limit and consistent payment history may contribute to a sense of stability within the profile. Over time, the account becomes part of the financial timeline lenders review when evaluating reliability. When several accounts with established limits exist within the report, they collectively demonstrate how much credit has been extended to the borrower and how that credit has been managed across time. Within the credit strategy framework, analyzing credit limits helps consumers interpret how revolving accounts contribute to the broader financial narrative recorded in the credit report. Instead of viewing the limit as simply the amount available for spending, individuals can recognize that it represents part of the structure lenders analyze when evaluating credit behavior. Limits establish the boundaries within which borrowing occurs, while balances reveal how much of that borrowing capacity is being used. Together, these numbers create the utilization patterns lenders review when assessing financial risk. Understanding how credit limits interact with balances and utilization, therefore, provides valuable insight into how lenders interpret the credit profile. By examining these relationships, consumers can analyze their credit reports with greater clarity and see how revolving accounts contribute to the overall financial history recorded within the credit system.